Welcome to the Forexx Report.
The US dollar, it's poised for a weekly loss against the euro.
What factors are influencing that?
It's a few things, really. You've got President Trump's recently delayed tariff plans and then the potential Russia-Ukraine peace talks. And of course, we've got recent US economic data to consider. All of this together, it creates kind of a unique opportunity for Forex traders. So let's take a look at why that is.
President Trump's decision to delay tariffs, especially the ones aimed at reciprocating the taxes other countries are putting on U.S. imports, that's really eased market fears and sparked some optimism about possible trade negotiations. This delay, it's had a positive impact on the euro and European currencies in general, and that's putting downward pressure on the dollar. Then you've got the dollar index that measures the dollar's value against a basket of major currencies, and that also weakened because of the lower than expected U.S. retail sales in January. This suggests we might see a two-time rate cut from the Federal Reserve this year. You put that together with the producer price report, which is indicating lower core inflation. And that's led future traders to price in 41 basis points of rate cuts for the year. And then on top of all of that,
There's the optimism surrounding a potential Russia-Ukraine peace deal. President Trump's discussions with the leaders of both countries, that's really fueled this optimism, and it's given the euro another boost. But some analysts are saying, even though the tariff delay is impacting the markets right now, those same tariffs could end up contributing to inflation in the long run. And if that happens, it could lead the Fed to maintain higher interest rates, which would ultimately support a stronger dollar.
Interesting. What's happening with the Japanese yen?
While the Japanese yen, that's also strengthening against the dollar.
Why is that?
It seems to be driven by concerns over U.S. economic growth, and there are expectations of potential interest rate hikes by the Bank of Japan. If you look at USD-JPY movements, you'll see there's a strong correlation with U.S. 10-year Treasury yields. Both have been trending downwards since they peaked in mid-January. And this correlation, it was really highlighted by the recent U.S. retail sales report. Now, if we shift our focus over to the UK, market observers are really watching the upcoming UK labor report for the fourth quarter of 2024.
This report, it should give us some insights into the Bank of England's potential interest rate trajectory. It's important to keep a close eye on the wage growth figures within the report. You see, strong wage growth, that could really contribute to inflationary pressures, and that could prompt the Bank of England to consider further interest rate hikes. Of course, any rate hikes would likely impact GBP exchange rates. And then in Turkey, the Turkish Central Bank has discontinued FX-protected deposit accounts for legal entities. This move is part of their strategy to phase out these accounts, which were originally introduced to try and stabilize the Turkish lira.
I see. Can you tell us about implied volatility in the Forex markets?
Well, implied volatility in Forex markets, it's decreasing, particularly for USD pairs. This indicates that the market is expecting smaller dollar fluctuations in the near future. But it's interesting, JPY calls are seeing consistent demand, which suggests that the market is anticipating further USD-JPY declines, and this is where traders can potentially find opportunities. The weaker USD and the improved risk appetite, those are contributing to this lower implied volatility. Especially for USD pairs, what this suggests is that there's a reduced risk of rapid USD gains in the near term, which could make a short position quite appealing. Then you've got risk reversals. They're showing a decreasing premium for USD calls over puts against EUR, GBP, and AUD. And this further reinforces the idea that a USD resurgence is less likely. Now, there has been some interest in buying USD upside strikes, but it seems to be limited to a specific range. The recent USD-JPY volatility, that's kept implied volatility from declining even further. But the current prices, they present some attractive opportunities for traders.
How might the upcoming U.S. holiday affect Forex trading?
Well, with the US holiday on Monday and limited key data releases next week, it's possible that larger FX option strike expiries and the related hedging flows, they might end up having a greater influence on FX trading. This could create some opportunities for traders who are closely monitoring these technical factors. There's also the thought that uncertainties around US policies, especially those tariffs, could lead to a bit of a slowdown in global economic growth in 2025. The expectation is that these tariffs are going to increase market volatility and probably inflation too, and that could potentially restrict central banks from easing monetary policies.
What about over in the UK?
So the British pound, it's actually at its strongest level against the dollar this year. This comes after the UK GDP data that really boosted confidence in the British economy. And you've got the weakening dollar. Due to that relief over the potential US tariff negotiations, it's all kind of tied together, the pound's strength, that's really attributed to this positive UK GDP data, which showed some unexpected growth in the last quarter of 2024. And this, coupled with the weaker dollar, that's what pushed the pound to its highest point against the dollar since December 30th. Now, Current market predictions, they suggest that the Bank of England might implement further easing of monetary policy this year, potentially up to 60 basis points. This is in contrast to the Federal Reserve, which is only expected to ease by a quarter point, and the European Central Bank, which is predicted to cut rates by at least 4 quarter points.
What data are market watchers looking at when it comes to the Bank of England?
So market observers, they're really eagerly awaiting the upcoming UK labor report for that fourth quarter of 2024. This report, it should give us some further guidance on the Bank of England's interest rate strategy, the data on wage growth, that's going to be crucial in determining what the Bank of England does. Continued strong wage growth, well, that could fuel inflationary pressures, and that could influence their decision on interest rates. And then going back to option expiries and those related hedging flows, they could have an influence on Forex trading next week. That's because of the US holiday on Monday and the limited key data releases. It's something to keep an eye on. And speaking of keeping an eye on things, remember USD JPY. There's that steady demand for JPY calls, many of them with strikes below 150.00 and expiries in the coming weeks and months. These would benefit from deeper USD JPY declines. Traders should also consider some of the less conventional indicators. While traditional economic indicators are still valuable, exploring alternative data sources, well, that can give you a unique edge.
What kind of alternative sources are you talking about?
Things like sentiment analysis tools, those can be really helpful. They gauge market sentiment by looking at social media trends, news sentiment, and online discussions. And that can offer valuable insights into trader psychology, and maybe even give you a hint about potential market direction. It's also a good idea to keep an eye on commodity prices, especially oil. That can provide clues.
About global growth expectations and potential currency movements. For example, if oil prices start rising, well, that could signal increased global demand, and maybe even lead to a strengthening of commodity-linked currencies, like the Canadian dollar or the Norwegian krone.
So we've been talking about the dollar's weakness, but what could potentially reverse that trend? That's a great question. The thing to remember is that the Forex market, it's constantly changing. So if upcoming US economic data, like inflation figures, come in hotter than expected, well, that could bolster expectations of a less dovish Fed, and that could support a dollar rebound. We also have to consider, what if trade tensions escalate despite that tariff delay? Or what if the Russia-Ukraine situation deteriorates? Either of those things could trigger a flight to safety, which would benefit the dollar, since it's considered a safe haven currency. So to sum it all up, the current market environment, it presents both opportunities and challenges for Forex traders. The dollar's weakness, driven by all those factors we discussed, it offers potential for short positions, particularly against the euro and the yen. But it's crucial to stay vigilant and be adaptable. You need to monitor those upcoming economic data releases. Keep an eye on any geopolitical developments and make sure you're incorporating both traditional and alternative data sources into your analysis. It's a complex landscape out there, but by staying informed and being prepared to adjust your strategies, you can navigate these waters successfully.